beneficiaries. So that visibility and using the eye. The next one is IFRS. I am sure here you have all heard about IFRS. IFRS, yes, was rolled out, but it has struggled really a little bit. We've struggled in terms of the rollout. We've struggled in terms of the uptake. So we don't have, it is one of those technologies that we are still having a number of our challenges with. But again, we are not giving up. So IFRS is here to stay. And IFRS really what it does is that we're able to see the sales. We are able to match and see the sales which are being made by the different taxpayers. We started off with just the VAT registered taxpayers. But ultimately the goal is to roll out IFRS to all the registered taxpayers. So that is the other technology that we are using in URA to be able to help us to monitor the sales of our taxpayers for tax collection purposes. The third one is for rental, where the Minister of Finance did sign an agreement with a company called Riponami. So Riponami has technologies that are going to track and help us to map the properties that we have in Uganda for purposes of rental tax collections. That as well, we were struggling because we were using the manual processes of having staff to go out and be able to map out these properties. So with the use of this technology as well, it is going to enable us to be able to examine the different property owners, the ones that have the rental tax to declare, and we should be able to use that technology should assist us in as well having improvements in rental tax. And then of course the last one that I can talk about are the scanners. With the scanners as well, they are going to help us to be able to look at the products that are coming in for international trade taxes. That we're able to know what products indeed are in the containers. So we have these scanners really along all the major border points. That as well has been in place, but now we are increasing on the scanners to make sure that all the borders indeed do have this technology. So you can see all these examples I've given is that we are going to focus a lot on the use of technology. Like I said, we do not have any new tax policy measures. So we are looking at all these different processes to see how best we can use the resources which have been given to us to be able to make the necessary collections that we need to make. The second area that we're investing in a lot as Uganda Revenue Authority is tax education. Dear participants, you all know if you've been to different areas, tax is one of those areas that people can never get enough of. But also because tax indeed is complex. It is an area that is constantly changing. It is an area that needs a lot of focus. So we as Uganda Revenue Authority, we are now changing the mechanisms on how we do interact with our taxpayers. And one of the things we have said, what we are going to do is to have the focus discussions. Discussions where it will not just be like a big hole like this, but you're segmenting your taxpayers and making sure that you listen to them, to each one of them, and see what areas they are struggling with to be able to focus and be able to address the issues. So tax education is very key on the priorities that we have. The next one is, of course, related to, just to summarize, is in terms of the staff capacity. We do not want our taxpayers to interact with staff that do not know their business. So it is very important for the tax administration to be able to focus on building the capacity of the staff that we have. So that is one of the other areas that we need to focus on, and we have made a number of our plans, particularly to also focus on areas that are very complex. Things like international taxation, oil and gas, those are very complex areas. So we need to build sufficient capacity within the URA to be able to handle these transactions that will come through. But we're also working with a lot of international tools. And the one I'll point out is what we famously call TADAT. That is a tax assessment tool that is used by all over the world to assess the strength of a tax administration. So we're also going to use that tool to be able to assess ourselves and see what are the weaknesses that we have internally, to be able to build on that and be able to make improvements or suggest areas that will help us in moving forward. And then, of course, we need to work on improving our tax register. Participants, we currently have a tax register that has only 2.6 million taxpayers. Now that is very low, like you can all imagine. But our target is to move to at least about 5 million taxpayers by the financial year 2024-2025. And so we need to have, or we are working with a lot of government institutions. We are looking at interfacing our systems to be able to get to detect the taxpayers that ought to be on a register but are currently not on the register. So we also need to work together. We are working with associations and a number of our government entities to make sure that we are able to tell or get numbers that can improve that tax register. The 2.6 million is really low, so we must make sure that we register as many people so that at the end of it all, each person gets to pay their fair share of taxes. So in summary, ladies and gentlemen, those are some of the key high-level areas that we are looking at as Uganda Revenue Authority to be able to improve our administrative efficiencies. And these are the discussions that we are going to have. So allow me now to get to my panel, the panel that is going to that is going to make detailed presentations on some of these areas that I've talked about, and we would then appreciate the feedback that you're going to give us in terms of moving forward. So the first panelist, and my dear panelists, I will call you, you'll come up and take your seat. The first one is Dr. Silva. Dr. Silva Namnane from the Ministry of Finance, please come and take your seat. Dr. Silva, as he comes, I'll make a small introduction about him. He is a tax policy specialist and a technical lead on the domestic revenue mobilization issues at the Ministry of Finance, Planning and Economic Development. He has over 10 years of experience in tax policy, but also with expertise in tax policy design and empirical analysis. Dr. Silva holds a PhD in applied economics and also a Master's of Arts in Policy Economics. So ladies and gentlemen, you're honored this afternoon to be able to listen to Dr. Silva. So put your hands together and welcome Dr. Silva. Dr. Silva, you are very welcome. Our next panelist is Professor Nadaisa from the Georgetown University. Professor Nada, please come up and take your seat. Professor, you are very welcome. Professor Nada is an associate professor of public policy and economics research and an associate at the National Bureau of Economic Research. From 2005 to 2007, she served as a deputy assistant of the Treasury of Economic Policy. Previously, she was on the economics faculty at the University of California. Doctor, you are welcome. We then move on to our last panelist, Mr. Liam Carson. This is a country economist at IGC. Mr. Liam, you are very welcome. Participants, please put your hands together and welcome Dr. Liam. Okay, so Dr. Liam is a country economist at IGC. He holds a Master's in Economics and Development Economics from the University of Nottingham. Before joining the IGC, Liam worked for several years as an emerging markets economist at the consultancy Capital Economics. Mr. Liam, you are welcome. And then we have a final panelist, Dr. Kylie, a tax policy advisor at the ODI. Doctor, you are very welcome. So participants, this is a distinguished panel that we are going to have this afternoon. Thereafter, we shall have discussions with two distinguished people as well that will discuss the topics. So each presenter is going to have 20 minutes, and my dear presenters, please try and keep within the time, because as you can see, we started a bit late. So we'll start off with Dr. Silva, and Dr. Silva is going to talk about a very interesting topic, the topic that I've talked about on the use of the digital technologies to be able to enhance domestic resource mobilization and economic growth. Dr. Silva, we are on our way, we are waiting for you. We need to be able to examine these technologies. What are some of the challenges that we are having in terms of our implementation, but also in terms of our moving forward, what must be done? We must be able to raise our tax to GDP ratio by 2024, 2025 to at least 18 to 20%. Under my boss, PSST, DST, we are on course for that. We will do everything possible to make sure that that is achieved. But of course, it is a combination of a policy and administrative efficiencies. And as the URA, I can assure you, we are very much on course and ready for that challenge. So ladies and gentlemen, please put your hands together and welcome Dr. Silva to take us through the first presentation. Doctor, you're welcome.
Thank you, Patience, and thank you, ladies and gentlemen. Protocol observed. We want to dive deep into our discussion today. It's going to be interesting, and I hope you stay entertained. Most people don't like to talk about taxes, but I think today will be a good one. Let's try and evaluate and see whether some of the technologies that we've adopted are actually working for us and are helping us deliver what we expected it would actually deliver. So we're only going to look at excise taxes. Excise taxes is just one of the broader taxes that we actually levy in this country. And we try to find ways to actually improve its performance by putting forward a trace and track mechanism, which some people may call a digital tracking solution, but in particular, these are probably digital tax stamps that are basically affixed on some of those goods that attract excise duty. Maurice, I thought this worked. All right, there we go. All righty. Okay, perfect. So, Patience has talked about some of the technologies they actually have at URA, and they've actually made a tremendous progress in kind of adopting some of these technologies. So, what we really need to get into as technical people is to try and see whether some of these are actually having some bit of traction in the sense that are actually improving compliance, or are they actually also reducing on the amount of time that taxpayers take to file their returns. At the end of it all, we want to see an increase in tax revenue. So the e-tax came in a little bit earlier. Patients forgot to talk about it, but that is a very important step that they took. They went away from having paper returns to having electronic returns. Those make it possible for us to do impact assessments and actually evaluate some of the things that we put in place, some of the policies we put in place, whether they're actually working or not. And my co-authors later will discuss a paper that uses some of that information. Now, today we're actually going to focus more on the digital tax stamps and whether they've actually been a little bit effective in helping improve compliance, helping the government raise as much revenue as they could potentially do in the sense in terms of excise duties. But also, we want to believe that using some of these technologies actually helps reduce on the amount of time that you potentially take putting together your returns. So I want to just kind of put ahead some key messages that you probably need to be aware of as we get into the technical discussion. We need to know that our focus today is on digital tax stamps and whether they've actually had an impact on farms' ex-factory prices. Now, why ex-factory prices? If you're very familiar with the excise tax system, it basically, when the rate is basically like, say, for example, 30%, it is always applied on the ex-factory price. Now, whenever you introduce a solution like the digital tax stamps, and the cost is potentially being borne by the taxpayer, what they can actually do, they can transfer some of that cost to the government by basically adjusting how they basically declare their ex-factory prices. So that is, it's a behavioral response that is triggered by some of the actions we take as government. So it is one of the outcome variables that we'll actually evaluate today. Now, if the digital tax stamps are doing what they're supposed to be doing, we should be seeing farms declaring relatively more sales revenues. And once they do that, we can actually expect also to see more government revenues. Do we actually see that happen? It is something that we're going to get into a little bit later. But just to give you a snapshot, we do seem to see some challenges in the first year of implementation of these digital tax stamps, but eventually we did realize that yes, there were potential gains that were basically came into place a little bit a year later. Now, given that we might have seen some successes, it might be worthwhile considering having a relatively lower price for the stamps and a uniform price. That is something that needs to be discussed quite extensively. I know that progress has been made, but more progress needs to be made, and we'll get into the details as to why that has to happen a little bit later. Now, for most people that know how the excise regime works in Uganda, it is often very broad. It just goes beyond the traditional objectives of an excise tax, of basically trying to limit consumption of what they might call sin goods. Those are basically alcohol or cigarettes or whatever goods that the community deems to be sinful. Those are mainly aimed at correcting for negative externalities. But the base for excises or goods that basically attract excise duty in Uganda, it's quite broad. It basically includes things like phone talk time, water, cooking oil, mobile money. And the reason for doing so is just raising revenue. We could potentially see a potential trend in the graph that suggests that revenues were potentially going up. And like you might notice in 2019, 2020, there's a big dip because of the pandemic, which we don't want to dwell a lot more about. And we also know that these rates are always adjusted. But for the government to actually be able to raise the amount of revenues they're supposed to be raising from these goods, we potentially expect that they should be able to actually track and trace production. So, for example, for some of those excisable goods. And how do they do that? It's basically because they use this tracking solution that was put in place. Now, has it actually been effective or not? It is something that we will actually get into discussing today. So when were these stamps introduced and what do they look like? If you picked a bottle of beer, you potentially see there could be paper markers. But if you looked at the bottle of water in front of you, there were basically going to be markings specifically on that water bottle that you're actually having. Now, there are things they call the Kakasa app that you can potentially use as a consumer to basically check the details of that product that you're buying to ensure that the product you're buying is legitimate. But ideally, these stamps they're meant to basically transmit information directly to URA as soon as the goods come off the production line, so that URA is able to have this information in a timely manner, and it can also be able to collect the amounts of revenue that are expected to be collecting. So we may not necessarily have under declarations, but businesses always respond. They could do something different that could potentially minimize their tax liability, and we need to be aware of some of those challenges. So DTS didn't actually come out once and become effective. There were challenges, issues to do with mass validation. So, for example, you are intercepted a truck full of excisable goods. They basically have to validate one by one, which takes a lot of time, and that is very costly for the businesses as well. Now, you could find that there could be goods on the market with stamps, but those stamps are not activated. So there are some goods which did not exactly have automated ways of actually activating those stamps. So you actually end up with goods on the market, they have stamps that they should, but those stamps are not activated. So those are some of the implementation challenges that URA faced while implementing some of these things. Now, these stamps were introduced at a cost. Initially, the cost was borne by the government, but eventually the cost was moved on to the taxpayer. If stamps are priced quite highly, that has implications in terms of how businesses actually respond to that pricing. We'll see a little bit of evidence a little later. And how much of our revenues actually comes from some of these goods that attract excise duty that are on DTS. In 2020, 2021, that was about 761 billion, which is about 0.5% of GDP. But how much of this can you actually attribute to the introduction of the stamps? It is something that we will actually get in a little bit later. Okay. Sorry, I'll just kind of keep going. So, in financial 1920, when these stamps were introduced, the government actually covered the cost for the first year. And that was about 62 billion payment that the government actually made. This was a one-off payment. Now, to actually get a sense whether these stamps are actually worthwhile investing in, the expectation is that the amount of revenue gain should at least be more than the 62 billion that the government invested in. Do we actually see that happening? Yes, we'll get into it, but a little bit later. Now, during the second year of intervention, the cost was actually moved on to the businesses. They kind of had to meet this cost themselves, and that could also alter their behavior in some way, but we'll also get to see some numbers as we go along. Now, the cost of the stamps was reviewed in February this year, and more products were basically brought on board, but that is basically out of the scope of the study I'm presenting now, but it presents room for extensions, because we kind of have to make more strong assumption, and also complicates the estimation method. So which goods are we actually talking about here? I might be talking about excisable goods when I'm talking to myself. We could potentially look at some of them. So this list basically includes those goods that were basically gazetted to basically attract to have digital tax stamps. And these basically included cigarettes, beer, spirits, wines, bottled water, sugar, and cement, cooking oil. So you might realize that sugar, cement, cooking oil in 2019, 2020 did not have digital tax stamps on them. That's why the unit cost is basically at zero at that particular point. But you might look at the pricing of the stamps for each of those different goods. When we interrogated further why that was the case, we were told that they did that potentially because of the elasticity of demand of these products, but you also remember that you have excise taxes on these products. And those excise taxes take into account the price elasticity of these products. We are selling a stamp for these goods, basically similar stamps. There is no justification whatsoever apart from helping the service provider recover their initial investment in terms of discriminating these unit costs for the stamps. So typically, we might have to think about a way of lowering the price of the stamps and kind of having a uniform cost for the stamps. It's meant to be a solution that helps us collect relatively more money. So I won't spend a lot of time on the next slide, but this basically shows you where we get our data. Our data comes from the tax returns at URA. It is monthly data, so basically looking at 48 data points, and the data is so rich that even if a farm produced more than one excisable good, we are able to get the information up to the product level. One thing we might have to take away from here is that the tax returns basically filed by those products on DTS, which we're calling treated returns, basically saw an increase after financial year 2019-2020, which suggested that actually the digital tax stamps were actually helping improve compliance. More people were actually filing, and these returns were actually coming in. Now, stay with me. Don't get lost in forget about the econometrics that you see on the screen, but let's focus on what we're actually trying to do here. When trying to assess the impact of some of these digital tax stamps, what we're doing in the instance we're comparing how the sales revenues, ex-factory prices, and excise taxes of the goods that are on DTS are actually changing over time as compared to those goods that attract excise duty but are not on the DTS. The assumption that we are making here is that the change would have otherwise been the same as those that are not on DTS if it wasn't necessarily for the DTS. But we know that assumption may not necessarily be valid, because when you look at the trends, they may actually vary over time, and we may have to relax that assumption. That is why we basically have two equations on the board, but you can look at the figures because they kind of help people appreciate most of these numbers quite clearly. When you look at the trends, they're not exactly parallel prior to the introduction of the policy. They do change quite a lot. The first figure is kind of looking at what happens to the ex-factory prices. Notice that in financial year 2020, 2021, we see the solid line is basically showing that for those farms that attract DTS, it drops quite significantly. It suggests that farms are actually reducing their ex-factory prices to try and shift some of the cost to the government. Now, when you look at the sales revenue, even if there's some decreases in the beginning, we see some gains coming in the second year, and those gains are quite large enough to allow the government to collect a little bit more money, as is shown by the third graph that captures the excise tax liability. It goes up quite significantly in the second year. What do these numbers look like? We basically see, I'll focus on the last column, which kind of captures the 17% decrease in ex-factory prices. But in that same period, we basically see an increase in sales revenue of about 30.7%. And once those sales revenues go up, we can expect more in excise duty of about, an increase in excise duty of about 28.3%. So typically, even if there were some implementation challenges in the first year, that we basically saw a decrease in revenue. In the years after, we're seeing a gain in revenue, and we're seeing an increase in the sales that are basically declared by these products that are on DTS. How much does that actually translate into in terms of actual revenues? We're looking at a gain of about at least 200 billion coming out of these digital tax stamps. That is a significant increase, and we believe that the solution is actually adding a little bit of value, and also helping us get to our targets. Now, there were challenges, but typically these challenges say that adopting technologies takes time. And there are always implementation challenges in the beginning, and also the issues around the pricing of the stamps. But over time, these challenges are overcome, and then we see some bit of gains in terms of revenue. So what we have to take away from this is that the price of stamps should probably be low and be made uniform for at least all the products. Now, this could minimize the tax avoidance behavior in terms of decreases in ex-factory prices, and in doing so, we could potentially have more firms being compliant without trying to reduce the ex-factory prices to shift the burden to the government. Now, in these discussions with our service provider, I think they need to leave issues of influencing consumption and minimizing externalities to the main excise law. They should not use the pricing of the stamps to try and tackle such issues. So typically, they shouldn't get into that space because that's already catered for by the main excise law. Now, they could also, I know that URA is working on some things in terms of improving the implementation challenges. These would help minimize the downtime that companies have to go through in terms of, say, for example, having mass validation equipment that will actually allow them to verify some of these stamps and also automate the processes quite quickly. This would allow the system to be implemented in a much smoother manner. Thank you, ladies and gentlemen. I would beg to stop here.
Thank you so much, Dr. Silva. So he's been able to give a snapshot, particularly in DTS. It is good to note, Dr. Silva, that you note that we have gained some revenues, really. Progress has been made, but maybe not where we want to go because our numbers are really a little bit higher. But he has also mentioned the challenges, really, and I'm sure for the taxpayers who are represented here, you know some of those challenges that we've had. One of them being the cost of the stamps. That is something that the taxpayers have brought to our attention and to the Ministry of Finance, but we are working on that. We did sign a contract with the SICPA, that is a provider for DTS, and one of the reasons or one of the clauses in there is that once you are able to hit certain volumes, then they will be able to reduce the prices. And they have already reduced some of the prices, particularly for the spirits. But that is an ongoing discussion. We are very cognizant that that price, indeed, of the different the stamps must be lowered to be able so that it is not such a huge cost on our manufacturers. The other area that he has pointed out is in terms of the uptake. And what we are doing as URA is to make sure that we reinforce our enforcement measures. How are we able to monitor the transactions, or how do we make sure that the DTS, indeed, the product lines are switched on and that they are not being switched on and off. So we are going to increase on the enforcement, and I am sure some of the taxpayers whose products are on DTS have already witnessed that. But it is a continuous journey, but the good story is the fact that indeed they are making an effort to make a contribution towards our revenue collections. But we'll have more discussions and we'd like to get feedback from you, the participants, when we get to the Q&A. So moving on quickly now is that we will then have our second panelist, Professor Nada, who is now going to focus on customs, international trade. International trade as well, DTS is majorly on the domestic taxes, but as you know, in URA, we do collect both customs and domestic taxes. So we now want to shift in terms of the customs, the tariffs. Where are we struggling? What can we do to raise the revenues from customs as well to make sure that we are collecting sufficient revenues from that? So ladies and gentlemen, put your hands together and welcome Professor Nada to be able to take us through for the next 20 to 25 minutes. Professor, you're welcome.
We have the slides. There we go. All right. Thank you very much for giving me this opportunity to present this work. It's a pleasure for me to be back in Uganda after the pandemic. So I'm going to be talking today about research that I'm conducting with several other folks who are listed on the slide. We've been working, and I should say they share equally in all of this, in all that I'm going to present. What I'd like to talk about is what we've managed to find. Working. Did it work? Okay. What I'd like to do is talk about what we found so far in our analysis of customs tax non-compliance. I'm going to use the term non-compliance and evasion interchangeably, and I'll talk about kind of why that's important in a moment. But let me just give the outline of kind of the presentation just to help you kind of put things in various places. So what I'd like to do first is motivate why this is an important topic to think about. And then second, I'll talk about how we measure import tax evasion with the data that we have. I'll say something about the fiscal cost of the evasion, and then I'll talk a little bit about the drivers. That is, what are the determinants of non-compliance or evasion. I'd also like to say something about next steps to get some feedback and thoughts on where this project can go next. Did I get to, this is like a game. Okay, all right. So we heard this morning about Uganda's tax revenue collection. Uganda collects about 11 to 12% of taxes as a share of GDP. That's low relative to the average in Africa, and it's also low. It's important for various reasons. One of which is that one of the main drivers of economic growth is an increase in the tax to GDP ratio. So the process of development is in part about increasing that tax share in GDP. Of course, there's also the issue of the fact that with too little revenue, the government is limited in terms of how much it can provide in terms of public goods and services. The challenge here is that there's significant non-compliance in this data. Trade taxes represent a major source of revenue for Uganda. So in the most recent data, which is 2019, we find that international trade revenues represent about 40% of overall tax revenue in Uganda. Right? So non-compliance or evasion in this in this domain has a direct and sizable impact on overall revenues. And that quote, which does not appear on the slide, is one that talks about how trade fraud in trade basically sucks a lot of revenue out of the Ugandan tax authorities. Okay. So what are the incentives in the customs tax arena? So currently, most finished products coming into Uganda face about a 25% duty rate. The range, though, is very wide. It's everything from 0 to 100%. Raw materials still come in, and capital goods can still enter duty-free. In addition, imported goods are charged a value-added tax of 18% and a withholdings tax of 6%, which is non-refundable, which means that in addition to the duty, there's an effective tax of about 24% on all foreign goods and services. So these are non-trivial taxes that increase the cost to importers, so the incentives for evasion are there. All right. So the goal of this project is to try to measure the size of this of the import tax evasion and also the effects it has. The data that I'm going to be talking about today comes from two sources. First, the customs data, which allows us to look at reported imports in Uganda and reported exports by the trading partner for the same year for the same good, or we could do it for kind of a series of goods. Right? So if you want to think about the exports that are reported by the trading partner as the truth, then we get a measure of how much evasion by comparing that to the reports in Uganda. The second source of data is the VAT data, which allows us to compare the customs declaration in terms of VAT liability to the VAT declared in the VAT tax forms. And this would be for the purposes of getting a tax credit. And this could be done for the same trader. So we observe how much is paid in principle at the border, how much is the firm claims to have paid when it submits for the credit. Right? In future work, what we'd like to do is match the customs VAT and corporate income tax data to try to understand the strategic behavior by firms and how they trade off potential evasion along different margins. Second thing we'd like to look at is the impact of evasion on the domestic market in terms of prices. And that has implications for what happens if we ramp up enforcement of these taxes. Okay. So firms have multiple ways in which they could evade customs taxes. On the customs declaration side, they could underreport the quantities that are imported. They could misclassify goods to avoid higher taxed categories, or they can underreport the values of the imported goods. On the VAT declaration side, they can overreport how much VAT they paid at the border, allowing them to get a larger credit on the VAT form, on the VAT tax liability. Okay, so what I want to do now is just show you what we find, or examples of what we find for all these all four dimensions. And I'll start with the customs data. All right. So the first margin we said is quantities. And so we take a random product. Here it's organic surface active products that are imported from the UK. And what you see here in this table is data from 2011 to 2018. In the first column is the year. The second column is how much is reported by importers in Uganda as having come from the UK. The third column is how much the UK reports it exported to Uganda. And the last column is the gap between the two. And for all of them, except one, you'll see that the UK reports more exports than imports that are reported here. And the gaps can be significant. So they start off at 50%, but they go up as high as 95%. And the other thing to note here is if you look just broadly at the average gap before and after 2017, when the tariff rate actually increased, you see a sizable increase in the average gap. So this suggestive evidence that firms are actually responding to these to the incentives. Okay. The second margin is misclassification. Right? So firms have the option, or importers have the options to classify goods along a series of dimensions. So this is, here we look at jute sacks and bags. These are bags that could be used, say, for packaging coffee beans. In 2016, there were no, the UK reported positive exports to Uganda, but there were none reported in Uganda records. Right? So those are what we call orphan exports. What's notable here is that the tariff on the jute bags is 45%. Right? It's in a sensitive list of goods, so it faces a higher tax rate. Now, what would an importer do here? Well, they could classify that same import as coming from other textiles. Right? That's the last row. That looks like the picture on the right, right? So the jute is the picture on the left. Yes, the jute is the picture on your left. The other kind of textile products is on the right. So if you simply just classify it as as being made of other textile products, you face a 25% tax rate. That's almost a 50% reduction in the tax that you face. Okay. And the third one we said is underreporting unit prices. What we look for here is shipments with unit prices that are far below the median for that good coming from the same country in the same year. And again, randomly, we looked at in this case, coming from India. And this table has a lot of information, but I want you to focus on the last two columns on the right. The first of those is the median value per kilo imported coming from India for that good in the same year. And the last column is the reported value by the importer. Right, so in that highlighted row, what you see is a number that is far below the median. It's 273 instead of 11,863. That's about an 80% reduction in the median price. And so that to us is compelling evidence that there's evasion taking place here. Now, the last margin along which firms can actually evade is on a VAT. So as I said, firms can receive a credit for VAT paid at the border. They claim that on Schedule 3 of the VAT forms, and so we're able to observe it directly. In the Asakuta data, the customs data, we know how much they reported or they paid at the border. So I'm going to take another random good here, other articles of plastic, and I'll show you how much this firm paid at the border and reported for tax credits. So the first panel is the assessment report from the customs records. That's November, and I'm just highlighting November 2015 here. And you see that the last column in that panel, and I can't read the number here, but it's something like 200,000. The declaration for credit purposes for that month was double that amount. And in fact, all along, you see that the amounts that are paid at the border are below what these firms are requesting for VAT credits. All right. So just to start off, we're interested in what the fiscal cost of this non-compliance or evasion, if we want to call it that. And so what we do here is just take a very simple first cut approach to the cost. And for each one of the margins that I mentioned, we basically adjust to get the amount that the firm should have paid, and therefore the amount that the revenue authority lost. So with quantities, what we do is use the trading partner reported quantities instead of what's reported in Uganda, and apply the statutory tariff and VAT rate to that quantity. With the orphan imports, we basically do the same thing, look at the exporter reported weight and quantities, and on prices, basically we look for cases in which the reported price is less than a quarter of the median for that good in that year. And here we look only at a specific set of goods that are referred to as undifferentiated. And so we adjust the price, the reported price, to the median price and apply the tax accordingly. And obviously for the VAT channel, for the tax channel, we take the amount, the discrepancy between what's paid at the border and what's claimed as the revenue loss. All right, so headline number here, in 2019, evasion from these four pathways led to lower collections on the VAT side and on the duty side that total about 7.5%. Right? 5.6% is on the VAT side, 1.9% on the duty side, and this is as a share of total revenues that come into the government. As a share of trade taxes, that number is closer to 20%. Right? So just the first pass estimate suggests that the revenue authorities collect 20% less in taxes than they should. And the figure here shows the estimated revenue loss from the VAT and the duty by different channel over a series of years. So there are different ways to think about kind of this revenue loss or the fiscal cost. The aggregate amount is about 1.35 billion Ugandan shillings that are lost to evasion. What does that mean? Well, we could think of it in terms of what could have been done with those revenues. In 2018-2019, the health budget was 1.6 billion. So effectively, the government lost what could have been essentially spent for healthcare in that year. So it's a significant loss of revenue. We also note that these are likely to be underestimated. Right? We don't take account of the withholding tax or any other taxes that might be at play. And once we include those, as we kind of progress, we'll get more accurate numbers. But they're large, is the main headline here. Okay. So what explains import tax evasion? From our data, we've been able to identify three different potential determinants. The first is tariffs. Makes sense. The higher the tax rate, the greater the incentive to evade. Second is the various characteristics of the consignment. The customs clearing agent matters. The sector of the firm matters. The product type and the country of origin. And third is fluctuations in exchange rates. And the idea here is a weaker or depreciation in the Ugandan shilling ends up making imports more expensive, increasing the cost to importers, creates an incentive to evade. All right. So these are just first cut or simple kind of visual representations of what we found. The first is the statutory tariff rate. What you see there is a tariff rate against the log of, or just the evasion, think of it as the evasions gap. And a positive line says that as the statutory tariff rate increases, the amount of evasion that we estimate increases. Right? So that's our first kind of cut at the evidence. Second is the sector of the firm. What we did for the past decade, or for data from the past decade, is identify and merge a list of about 80,000 active importers in Uganda with the VAT tax registers to figure out what sector they operate in. And you can see that the evasion is relatively concentrated in 3 sectors: ICT, manufacturing, and retail. And so this is useful in part because we want to provide information to URA to better identify where the evasion might be taking place. And the last one is, that I'll present here, is exchange rate fluctuations. So this figure shows the change in the exchange rate, in the Ugandan shilling exchange rate, against the VAT gap. Right? And the number goes from minus to plus. On the minus side is depreciation in the exchange rate. So think about it as cases in which the Ugandan exchange rate falls by 20%. And as we move to the right, we get towards appreciation. Right? The fact that the line is downward sloping says that when the exchange rate depreciates, we end up seeing more evasion, as we predicted. Right? Depreciation increases the cost to importers. That increases their incentive to evade customs taxes. Okay. And finally, I'll end with kind of where we want to head next. Right. So what we'd like to do next is think a bit about the spillover effects. And one question that we're particularly interested in is the winners and losers from customs tax evasion. So one question is, does evasion benefit consumers by lowering the price that they pay for goods? And the corollary to that is, what would the burden of enforcement be? Who ends up paying if we enforce the customs tax more rigorously? So we're trying to get price data to look at the local price effect. So yeah, I kind of said what I need to there. Second, I think more broadly, we'd like to think more about how import tax evasion factors into the policy process, or the policy decisions. So for example, does the VAT revenue, what we gain from the VAT by raising tariffs, to what extent would that be constrained or counteracted by increased incentives to evade? You can think of this as what we call a form of dynamic scoring. That is to say, we want to take into account the behavioral response when we change taxes, and not assume that various actors are going to stay and behave the same way. And that was the last slide. So I'll stop here. Thank you.
Thank you so much, Professor. I think she's given us very useful insights, but particularly what I liked about her presentation are the numbers, because the numbers indeed do tell the story. Yes, we have carried out studies in the URA, but I think we have not gotten to that level where we are able to estimate or have numbers that would point towards the different evasion schemes. So, Professor, that is a very useful information. We will take that paper as the URA and be able to study it further and even see how best we can also work with you to enrich that. And also working on some of the areas where you have raised policy implications that we need to focus on. The other area that we also need to emphasize is the use of the values, the differences in values in customs of lead, in addition to misclassification, is also another developing area where we notice that indeed we could, if we do not pay attention to it, lose significant revenues. So one of the things that we have done as a start is to have at least a central database where the values for the different products indeed can be obtained, but that is also a work in progress. But it is one of those areas that is developing that we need to focus on. So moving on quickly now, Maurice, I know we're almost done, do not worry. We'll move on to the last two discussants or panelists. And here we're also going to look at a very interesting topic in terms of tax policy, and that is the issue of tax incentives. I know PSST as well, this is one of the topics that you're very interested in. But it is important for us to see as a country, yes, we are giving out a lot of tax incentives, which are indeed provided in the different laws for domestic taxes and for customs. But the question is, are these incentives really adding value? Should we continue with the trend of having different incentives for the different sectors? What is the cost benefit when you look at the different incentives that we have in the law? So this particular session, for the next 25 minutes or 20, we are going to have two gentlemen that are going to dive into this particular topic of tax incentives and the development. When we look at the cost benefit of these incentives, is it something that the government needs to pay attention to? Are we losing significant revenues, or is the country foregoing revenues? And yet, as a country, we do not seem to see on the other side, what are we benefiting as Uganda? So that is a discussion that, ladies and gentlemen, we are going to have. And after that, we will then invite our two discussants. And then we shall also give you an opportunity to hear from you. So welcome with me. We are going to start with Mr. Liam, that is going to be the first person to discuss the tax incentives and development, a topic that is very key to our heart as we strive to raise sufficient revenues for the development of our nation. Mr. Liam, the floor is yours. So just take about 15 minutes, put your hands together, and welcome Mr. Liam to handle this topic first.
Hi, good afternoon, everybody. So I'm going to be co-presenting with Kyle McNabb today, and we're going to be presenting some preliminary results from a paper that we've worked on with Dr. Silva Naminane, who you've heard from already today. So our presentation is going to talk about one of Uganda's key tax incentives designed to support investment, thinking about, has this incentive achieved its intended objectives? So I'm going to start by giving a sneak preview of some of the key messages that are going to come out in this presentation. Now, I think the first thing to say is that there has been a real surge in the amount of foregone revenue which has arisen from Uganda's tax expenditures in recent years. And this has really prompted policymakers to think about, how can we rationalise the tax expenditure framework? And this ultimately creates a need to think, right, which tax incentives are working and which tax incentives are perhaps not working as well as we might have intended. And this ultimately requires a cost-benefit analysis. Now, in recent years, we've seen a lot of work trying to attempt to quantify some of the fiscal costs by revenue foregone. But as the PSST pointed out earlier, we need to kind of think about the benefits. The costs are only one part of the story. Are we getting benefits from these incentives? So this is the inspiration for our study. And we want to try and assess the benefits associated with the most widely used income tax holiday, which is section 21.1.AF of the income tax law. And this essentially offers a 10-year corporate tax holiday to strategic investors. Now, we find that since the introduction of this provision in the 2018 to 2019 financial year, it appears that the beneficiaries of this investment incentive have probably invested more than those non-beneficiaries. But we find far less impact of any evidence on other economic outcomes, such as firm turnover or labour market outcomes, which of course provides some doubt about its success as a tax incentive. So I think the final key message on this slide, before I move into the presentation proper, is that the number of beneficiaries from this investment incentive has risen really quite sharply in recent years. And I think there's a real risk that this trend is going to continue, and that ultimately risks eroding a corporate income tax base over the coming years. So now that I've provided a quick preview of our results, I'm going to move into the presentation. Sorry, before talking about tax incentives exactly, I want to talk about the broader fiscal situation, which will provide some context for why all of this is important. As we saw earlier, there's been a really quite sharp rise in Ugandan public debt in recent years. And debt is now around the threshold outlined in the Charter for Fiscal Responsibility. So even kind of before the COVID-19 pandemic, you'd seen government debt climb from 18% of GDP in 2011 to 37.6% of GDP in 2019. As the PS outlined earlier, we've seen a much bigger rise during COVID as policymakers diverted money towards social spending and health spending to mitigate the impact of the pandemic. So what does this mean? It means that fiscal consolidation is on the cards. In other words, policymakers at MOFPED are trying to narrow the budget deficit over the coming years. Now, if you look at these two charts, in the top left, we have the Ministry of Finance projections for the budget balance, and this was taken from the last background to the budget document in June, and it shows that the Ministry are projecting that the budget deficit will narrow from 7.3% of GDP in the 2021 to 2022 financial year to 2.3% of GDP in the 2026 to 2027 financial year. If you look at the chart in the bottom left corner, this is probably the most important chart on the slide for our purposes. It shows how the government thinks that this deficit reduction will be achieved. And we can see that policymakers expect revenues to increase from 13.3% of GDP now, these are non-oil revenues I should say, to 16.2% of GDP in 5 years' time. So this is a 0.5 to 0.6% increase in revenues every year in line with the domestic resource mobilisation strategy. So given the extent of revenue raising that we have to do, this obviously brings tax expenditures under the spotlight. And we've seen many estimates of revenue foregone from tax expenditures in recent years. The numbers I'm going to focus on are taken from a report compiled by the Ministry of Finance together with URA and together with Dr. Kyle's organisation TaxDev. And they show that tax expenditures have risen really quite sharply in recent years. We've seen that in financial year 2016 to 17, the revenue foregone from tax expenditures stood at 0.87% of GDP. In the most recent fiscal year, that has risen to 1.56% of GDP. And irrespective of the methodology you use to calculate the revenue foregone from tax expenditures, all of the reports that have been written on this topic show the same trend. We've seen a really quite steep rise in the revenue foregone from tax expenditures over the past few years. So, with the cost of expenditures rising really quite quickly, policymakers feel the need to perhaps try and reverse this trend. And actually, one of the structural benchmarks in the IMF Extended Credit Facility Agreement is that the revenue foregone from tax expenditures will decrease by 0.1% of GDP in this financial year and 0.2% of GDP in the subsequent years. So in this environment where policymakers are really thinking about how do we save money on tax expenditures, it's really quite important to properly think about what is working and what isn't working. Let's try and quantify the benefits. And how do we do this? How do we measure the economic benefits from a tax incentive? Well, it's a very, very complicated question, is the first thing to say. And it requires a lot of research, which policymakers should commission over the coming years. But I think with our study, we're trying to take a small, but hopefully important first step to trying to answer this question. So I'm just going to give you a very quick overview of how this revenue foregone comes about via different tax heads, if the clicker allows me. Yeah, here we go. So we can see that VAT tax expenditures account for the largest source of foregone revenue. But a key point I would make is that this foregone revenue is really quite split across different tax heads. This is a broad-based issue across different types of tax. And we're actually going to focus on income tax incentives and one specific incentive, and that is Section 21.1.AF of the Income Tax Act. And I want to talk quickly about why we choose to focus on that provision. If you can bear with me one moment. Okay, so I think this chart is really important. Now, what does it show? It shows corporate income tax revenues as a percentage of GDP across sub-Saharan Africa. And if you see this pink dotted line going across, this is the sub-Saharan African average, which shows that corporate income tax revenues typically average 2.4% of GDP across sub-Saharan Africa. Uganda, corporate income tax revenues are 0.9% of GDP. This is the second lowest of the 35 countries included in this sample. So you'd have to say Uganda performs really quite poorly on this measure. So we don't kind of have much room for further corporate income tax base erosion, is the point I would make. Now let me move on to the second justification for why we're focusing on this one incentive, which from now on I'm just going to call the income tax incentive. So if you look here, we can see that Section 21.1.AF, the income tax incentive, is the most widely used tax holiday included in the domestic tax laws. In the most recent financial year, there were 38 beneficiaries from this provision. And sorry, I want to, let me go back actually. Sorry, bear with me. The clicker is failing me. Sorry everybody. Okay, here we go. Just going back a slide. So I want to outline, since we're going to talk about this incentive, I want to provide some background. So this income tax incentive is available for firms that meet a set of qualifying criteria. Number one, they must operate in one of many priority sectors. Number two, they must meet a qualifying investment threshold. Now this stands at $10 million for foreign firms, and it stands at either $300,000 if you're a domestic investor and you're placing your asset in Kampala, or $150,000 if you're placing your asset up-country and you're also a local investor. There's three other criteria. One is that you need to source 70% of your raw materials locally. You also need to have Ugandan citizens accounting for 70% of the aggregate wage bill. And Ugandans also need to account for 70% of employees. Now, I really want you to focus on this slide. I think this slide is very important. It shows how Section 21.1.AF, the income tax incentive, has changed over time. Now, if you look on the left-hand side, we can see the qualifying investment to qualify for this provision has fallen for, let's focus on just the numbers for domestic firms. It's fallen from $5 million when it was first conceived to an investment threshold of just $300,000 if you're placing your asset in Kampala, and $150,000 if you're placing your asset up country. So that's 3% or 6% of the initial number. That's a really quite sharp fall in that investment threshold. And the second thing I want to show on this slide is how this provision has been extended. So if you look on the right-hand side, we can see the qualifying sectors. And you can see over time, the number of sectors which can qualify for this provision has, again, really increased quite dramatically. And ultimately, if this is such a broad-based incentive that applies to so many people, you risk eroding your CIT base, your corporate income tax base, in the long run. And I think this next slide highlights that risk. Okay, so this slide is demonstrating the number of new firms that benefit from this investment incentive over time. Now you can see, when it was first introduced, there were just 2 beneficiaries in 2018 to 19. In the last financial year, this has risen to 18 new beneficiaries, bringing the total number to 38. Now, why has this happened? It might be due to the expansion of the qualifying sectors. It might be due to the investment threshold coming down. Both of these factors are plausible, but the key point is that this is a trend which could easily continue over time. The idea that the number of new beneficiaries keeps increasing, and ultimately you end up with a large number of beneficiaries, and that ultimately could risk eroding Uganda's corporate income tax base. So I've spoken about some of the potential risks related to this provision. So I've sort of been a bit negative. But my colleague Dr. Kyle is going to come and talk about some of the benefits. Has this incentive helped to boost investment, and has it helped to support other economic outcomes?
Thank you, Liam. I think Liam has quite well set the scene for why it's quite timely and important to start an evaluation of these sorts of tax incentives. There's numerous reasons that he's outlined there why this is quite timely. So he's left it to me to outline the sort of empirical modelling approach that we take and to preview some of the results from our study. So for those of you that were here for Dr. Naminamu's presentation about 30 minutes ago, we employ the same technique as he outlined. So I'm going to hopefully be able to skip over most of the technicalities, but essentially we're looking at a difference in difference modelling technique, which allows us to, or helps us to estimate the economic impact of the introduction of this incentive across 3 key outcomes. The first one we look at is investment. Then we look at firms' turnover as proxied by sales revenues and firms' total wage bills. And so essentially what we're trying to do is we're trying to measure the changes in these outcome variables for beneficiary firms vis-a-vis firms that don't benefit. And in slightly more technical language, we call these treatment firms and a control group of firms. And the data from this comes from the URA's firm-level corporate tax returns. So in order to first look at the first outcome, which is investment, so plotted on the screen there is the logarithm of average fixed assets across our 2 groups of firms, the firms that benefit, shown in red, and the firms that don't benefit, eventually shown in blue. And our question is, how have the average asset stocks of these 2 sets of firms evolved over time before and after the insertion of 21(1) in the Income Tax Act? So I've hidden the second half of the screen of the chart to try and build a tiny amount of suspense. But broadly you can see, before the insertion of that amendment to the Income Tax Act, that the trends were moving roughly in the same direction. In more technical language, we would call that the assumption of parallel trends would be holding, which adds some validity to the modelling that we're undertaking. Now, after the insertion of the amendment to the Income Tax Act, we see a change. So we see that on average, the fixed asset stocks of those firms that benefit jumps up vis-a-vis the firms that don't benefit from the incentive. And this is some reasonably positive evidence in favour of the fact that beneficiaries of the incentive have invested more vis-a-vis what we have modelled they would otherwise have done had they not got that incentive. Now, the results are less clear for our other outcome variables. The first one we look at is turnover. So again, we're asking, how has the average turnover of treatment firms evolved vis-a-vis control firms before and after the insertion? What we see this time is that already in the financial year 2017-18, which is the year before this incentive came into statute, that there was already a difference in trends. So those firms that ended up benefiting from the incentive were already posting higher sales revenues for that year. And this is a trend that we see continuing, and a sustained gap between those 2 groups of firms after the insertion of the amendment to the Income Tax Act. And indeed, the gap grows marginally in the most recent 2 years, even during the pandemic period. So you see that the firms that have benefited from 21(1) their average sales revenues have continued to grow even when the control group of firms, the revenues took a slight dip in those years during the lockdown periods. And the final outcome variable that we looked at was the effects on firms' aggregate wage bills. Now again, you see here already the two groups of firms, the trends were moving in a different direction before the insertion of the amendment and before the beneficiary firms received the income tax holiday. And you see some mixed trends afterward. You see a slight dip in the average wage bill of those treatment firms in the initial year, and then the gap starts to widen again. So this difference was pre-existing between the two groups of firms before the incentive was granted or benefited from. So we've uncovered a couple of different results there. And for those of you who are interested in the slightly more technical econometric side of things, we've estimated 4 different specifications according to different modeling assumptions, which Dr. Namanane is going to outline in our paper, which is forthcoming. And when we look at these, this casts some doubt on the relationships previously shown. What you do see is that for total fixed assets, which was the first graph we showed, across each of the 4 specifications in the 4 columns, the effect is always positive. It's only statistically significant in the first equation, but the effect, or the direction of the effect, seems fairly positive across different specifications. However, for the other outcome variables, some doubt is cast on our findings. Actually, we see an ambiguous coefficient on the degree of turnover, and the same for the wage bill, where in some specifications it looks like there might be a positive effect vis-a-vis control firms. In other specifications it looks like actually there may be a negative effect there. So the results previously shown in the graphs only hold, or the statistical significance of those only really hold under certain modeling assumptions. But the effects on investment do appear to be positive across those different assumptions, but less clear for the other outcome variables. I should say that this is a work in progress. These are our results to date, and we do intend on digging a bit further into these as we move forward with writing the paper. So to do a sort of brief wrap-up, I think, as I said when I took the microphone, Liam set the stage pretty well for the context of this study. Uganda's corporate tax collection is poor relative to its neighbouring countries and its peers. Debt to GDP is rising, and there's pressure from various corners to curb revenue forgone from tax expenditure, which has been rising over the past 5-6 years. We do find evidence that the insertion of this tax incentive in the Income Tax Act may have prompted beneficiaries to invest more than they otherwise would have, and invest more in relation to firms that do not benefit. If your outcome of interest is investment, then we would say there is some positive evidence there to support that this amendment has brought more investment. But we also see some evidence, as shown by the fact that beneficiaries on average already had larger wage bills or already had larger turnovers, that bigger firms are disproportionately able to benefit from this incentive. We don't find strong evidence at this point that firms benefiting from the incentive end up generating a higher turnover or have a total higher wage bill vis-a-vis non-beneficiaries. I think the last point is quite key, and at the moment we rely on the sort of descriptive graph that Liam showed, that the increasing number of firms benefiting from this incentive does present a growing risk of more substantial CIT base erosion in the medium or the long term, or over the 10-year period of that tax holiday. In terms of policy takeaways or policy recommendations based on what we found, I think the key one is the first one, that close monitoring of the rising number of beneficiaries is key. The outcomes we've looked at to date in our study should be re-estimated on an annual basis and monitored closely. I can't underestimate the fact that doing this kind of work takes time and it takes resources. There's no quick answer to are our tax incentives working, or do the benefits outweigh the costs. This is one entire working paper on one tax exemption. There are many tax expenditures in Uganda's tax acts, and each of those in order to estimate the potential benefits, would require similar levels of detail in cost-benefit analysis. In terms of thinking about 21(1) itself, if there is a concern over future corporate tax base erosion from those rising number of beneficiaries, there's a number of options. You could, of course, remove the tax incentive from the tax code, which would mean no further corporate tax loss from future investments. However, if it's to remain in the code, it could be that it remains only for another few years, or that perhaps there's a cap on the number of firms who can eventually benefit from that incentive before it's removed. Other ways of tightening up potential base erosion from this might be through trimming the list of benefiting sectors or increasing the qualifying investment threshold. I'm going to leave it there. Thank you very much. This, as I said, is very much work in progress, but we think we're heading in the right direction, we hope, with some of our findings, and we look forward to your comments. Thank you.
Thank you very much, Dr. Kylie and Liam. Very interesting findings. As Dr. Liam was coming to the recommendations, I saw my bosses looking at each other. I think he has given them very interesting takeaways, things that to look at, but I think they're valid. So PSST, I think the work is cut out for us to be able to see, to examine this research deeper and see what is the way forward. But what is very clear is the fact that indeed the beneficiaries, particularly for income tax, are increasing, and that is because we have actually lowered the threshold over the years. That section has also been amended so many times, and it is creating a bit of instability, but in terms of administration, but also the certainty around it. But what is key then, I think, is to re-examine the provisions. The other area he mentions is under VAT. Deemed VAT, although Doctor, you didn't talk much about that, but definitely VAT, I think, is also another area where there's need to close examination of the incentives that we have under the exempt schedule and the ones that are zero rated, to see and determine whether we need to also progressively reduce the exemptions under VAT. But definitely deemed VAT is one of those areas, and I was glad that you pointed it out, although not much in detail, but that is interesting work, Liam and Dr. Kylie, that we also want to see some of the recommendations are coming through. So without going into further details, we'll now have two discussants, two distinguished ladies, and one we are going to start with Miss Isabella, the IMF resident representative. Put your hands together, ladies and gentlemen, for Madame Isabella. You're very welcome. We are looking forward to your insights on the presentations that we have had. Please have a seat. Yeah, please have a seat. Let me also call upon Miss Pamela Natamba. She is from a PwC. She has led the tax practice in a PwC. She also has 18 years experience in dealing with the taxpayers, particularly in policy issues, but also advisory. She is representing a PwC. So we will have some insights from the two ladies from any of the topics that we have discussed, but also it will be important to hear from them if they have any other recommendations that the Ministry of Finance or the URA can take away in a bid to improve revenue collections. So we'll now start with the IMF representative. Please come over, Madam, and then we'll have maybe just 15 minutes or so.
Three.
Oh, three. She says three. So Maurice, she says, I know she says three. But two. You're very welcome, Madam.
They gave me two.
No. She's very.
I know what I have to say.
No, I am sure our participants would love. So you're welcome, and let's hear from you, ma'am. Thank you.
Thanks very much. Thanks very much. I have only a few brief comments on Liam's and Carl's paper. So the working paper rightly places the analysis of the effectiveness of tax expenditures into the context of Uganda's fiscal space needed to boost development. Domestic revenue mobilization is dearly needed to boost spending on sustainable development goals, and curtailing ever-growing tax expenditures is without doubt a crucial ingredient to achieve it. While there are numerous estimates of the size and cost of tax expenditures, depending on the policy objectives and the benchmark tax system used, even the lowest estimate points to a potentially large pot of resources that is currently not available to the government to support spending. Regardless of the benchmark used, it is also clear that tax expenditures have continued to grow over time. As costing and publication of tax expenditures continue to be refined over time, policy decisions on how to rationalize them face three main tasks. 1. Weighing fiscal costs against benefits that tax expenditures may produce. 2. Evaluating suitability of existing tax expenditures for achieving the stated objectives against other available tools. And 3. Ascertaining the continued desirability of targeted objectives themselves. As one of our development partners said in a recent event, tax expenditures must be seen as an investment, and we should continue to ask ourselves what the return on our investment is. The IGC working paper contributes to the formulation of government policies by analyzing the benefits arising from one of the most widely used tax expenditures. As we remember today, this is not the only way through which tax expenditures are awarded. As the paper shows, the corporate income tax rate in Uganda is high, but revenue collected is below peers, making tax productivity low, in addition to introducing unfairness, complicating the tax system, accounting, and reporting. The beneficiaries of this incentive have grown over time, according to the findings, and are shown to have invested more than comparable firms in the same sector, not enjoying the same incentive. However, corporate revenues and the wage bill of these firms, hence potentially also employment, have not increased proportionally, putting in question the adequacy of the very return to this investment. Repealing the 10-year tax holidays for the corporate income tax is one of the recommendations in the paper. I would say the government could think at least about narrowing it, shortening the time, while grandfathering existing benefits, which is a measure that could be already taken in the short term. If the tax base is broadened over time this way, the corporate income tax rate could be reduced, which would eliminate distortions, facilitate tax compliance, enhance equity, as all businesses would benefit from the reduced taxes. This would not only bring much needed revenue to the government, but it would also enable entry of new firms into the market and boost job creation. Thank you very much.
Indeed, Madam Isabella, I think she has stuck to the 2 minutes that you gave her. Thank you so much, raising very pertinent issues again on the tax incentives. I think that is work in progress. That is a discussion indeed. That must continue beyond this to see how best these incentives can be rationalized. Two main areas that come through, even when you look at the tax laws, is that there were two areas that our government focused on. One was on the use of the local raw materials. These companies actually using the local raw materials. The other condition was on employment of our citizens within the EAC framework. So I think in terms of monitoring, in terms of looking at this discussion further, it is for both the Ministry of the Finance and the URA to be able to monitor these firms that are increasing in number. That is something indeed from the study that has come through, that the beneficiaries have increased. So then the question is, are they actually complying with these two conditions that are contained in the Income Tax Act, but also in the VAT Act and the Stamp Duty Act, as well as the excise duty? So that is work that is cut out for us to be able to make an analysis on that, as well to make sure or make some advice or guide the Ministry of Finance on what we, the ones who are implementing as the URA, what do we see on the ground and that study at PSST is ongoing, and we should be able to make a submission to the Ministry of Finance very soon, so as to make an input as we get to the policy discussions. So we'll now turn to our next discussant, Ms. Pamela as well, from the PwC. And Pamela, we are looking forward to hearing from you, because on one side she represents a lot the private sector. So it is, let's hear as a representative, as the person that deals with the taxpayers, what is coming through, what is that feedback that we need to see, what areas are our taxpayers unhappy about as a result of the discussions that we have had. And arising from that as well is that we should be able to pick up some areas that we can take up in terms of our policy development, or even areas that we need to change from the administration side. Because like I said at the start, increase in revenues is a function of both policy but also administrative efficiencies. So Ms. Pamela, you're welcome. You have about 5 minutes at most. Let's put our hands together and we'll welcome Ms. Pamela.
Good afternoon, ladies and gentlemen. I will try and use less than 5 minutes. It's a topic that is dear to my heart. It's difficult to use less than 5, but I will use less than 5. And I just want to add that as a tax advisor, I'm a very patriotic Ugandan who, while advising my clients, I want to make sure that I am making sure they pay what is due to the government, but also paying the right taxes. So I would like to start with comments on the last presentation, which was around tax incentives. And I know the team that presented focused on one section, which is the 10-year exemption for corporate income tax. And I was very intrigued by the conclusions from that presentation, specifically saying, yes, there's a recognition that we are not doing well from a corporate income tax perspective. However, then saying they cannot conclusively say that's because of this incentive that we are talking about. And as I was reflecting on that, I just thought one of the things that we should be reflecting on is how do we make sure that we balance incentives that we give that are driven from an income or profit perspective versus those that are driven from a tax deduction perspective. Because looking at those slides, I think there's one of the slides that was mentioning that even for these new investors, sometimes they will take a couple of years before they make profits. So even when you grant them these exemptions, chances are they're going to have tax losses that are arising from capital investments that they have made, and ultimately you will find they are not really utilizing this exemption. And that means that government is not necessarily losing any income, but also the taxpayer is not necessarily gaining from this exemption. Now, if that is the case, what is it that we want to think about? Again, we saw in the presentation that the expectation is if you get this exemption, you should employ Ugandans, your wage bill is 70%. If we are not seeing the benefit from a corporate income tax perspective, are we seeing the benefit from the perspective of these other taxes? Because if I say let's employ Ugandans 70%, and we are still not seeing a change from that perspective, where are we not getting it right? Is it an issue of how we are monitoring, for example, or implementing these conditions? If we say employ 70% Ugandans, it's on paper. Is it actually happening on ground? So patience in terms of what I think we should be doing as administrators, which is the URA, is to not just check that these investors are meeting those conditions when they are requesting for those exemptions, but rather also look into once they are 1, 2, 3 years into operation, are they actually still meeting those conditions? Because I get a feeling that much as we may not benefit from corporate income tax, we should be able to benefit from the other taxes, especially if we are going to make sure that the local content aspect is utilized. My overall view as a tax practitioner is I still believe there's a point of having tax incentives. It's just thinking about who is our target, what is the eligibility criteria, what's our objective, and what do we want to achieve. And other incentives that we had back then, 10 years back, 2015 and before, are they still relevant today? If we are talking about our priorities, from a national development plan perspective, or the sectors that we are focusing on, how are we then tailoring our incentives to those particular sectors that we would like to develop? Or if we are thinking about deductions that we give as opposed to granting exemptions on income, can we think about these deductions, the capital deductions, and say, if we say the rate of tax was 40% back then, is it still relevant today on these capital expenditures? And I'm glad that process has already started, but I think we need to continuously review it and make sure that whatever it is we are proposing as the government is still relevant in the current circumstances and where the economy is going. So I'll just also make some very brief comments on the other two presentations. One on the issue of the tariff revenues. I think a lot of revenue, in my view, there's potential in addressing increase in domestic revenue through addressing tax evasion as opposed to proposing increments in tax rates. Because as we saw from the presentation from Professor Nada, if you increase tax rates, you're most likely just giving an incentive for more evasion. Whereas if we look at all the gaps that were identified, there's clearly elements of people declaring wrong values, there's elements of under-declaration. So there's a lot that can be done in that space, in my view, as opposed to focusing on increasing the customs rates or taxes. And I know there's the pressure in terms of collection, there's pressure in terms of supporting local industrialization, but at the end of the day, being able to balance that support for local industrialization versus also encouraging our taxpayers here to grow their businesses, to support their business models and practices, I believe is critical. And my final comment then is on leveraging the digital technologies. Again, very, very good initiatives there, especially aimed at curbing tax abuse and improving compliance monitoring. I think it is important that the application is consistent with the objective. Patience, I'm glad you mentioned that the stamps cost is being revised. I recall when we were engaging with the manufacturers, the Alcohol Association, the cry was the cost of the stamps was really high. So the incentive should be able to minimize or to encourage the legitimate industry players so that they can remain in business, grow revenues, and at the same time minimize consumption of illicit goods, because at the end of the day, if the cost of compliance becomes very high, then you will end up encouraging the non-legitimate players in the space, while the objective was to try and minimize that. So I'll pause there because we don't have so much time. Thank you so much for listening to me.
Thank you very much, Ms. Pamela, for those insights. She makes very interesting points as well on the incentives and the need for us to monitor them. I think that is one of the key lessons that we can take from this session, that as government, we need to pay particular attention towards monitoring of these incentives, but also making sure, or looking at, if you're looking at income tax, corporate income tax, what is the impact of these incentives on tax heads like pay-as-you-earn, for instance? Are we seeing any numbers growing in terms of a pay-as-you-earn from these beneficiaries of the exemptions, or are the numbers stagnant? So that is one key point that Pamela does raise. Then, of course, the other issue is the issue of our tax rates that was also talked about by Professor Nada, that not necessarily, yes, we might want to raise significant revenues from these products, but at the same time, you could be encouraging, it could be counterproductive, where you instead encourage smuggling. So there also has to be a balance between the two and looking at the best way forward. So participants, we have come, Maurice, we have not disappointed you, we are done. So we'll now get to the question and answer sessions. Any question, fire away. The panelists, the discussants are all here. We'll take about 5 questions. So Maurice, I will let you be able to move around the microphone. Sir, you are welcome.
Thank you very much. My name is Kawoya Chigongo Samuel. I'm a retired magistrate, meaning I'm a patriot. I've served this country. My question goes to Liam, Carson, and Kyle. One of you can answer, or both of you can answer. Incentives, apart from the reasons you gave why they were put in the law books, is for attracting investors to come into the country so that they can develop the agro-industrialization sector of our economy as well as heavy industry. After which, we can reverse the law and say, okay, we no longer need incentives, so the law can be reversed. For now, investors are very few and are competed for. We need them. For the time being, we beg to move that you don't worry so much, because economists, that's your problem. You worry too much. We will get there because we haven't reached the critical mass which we need in Uganda. I beg to move that even that reason be considered. Not so much about the empirical data that you need to prove your case. Uganda also matters. Okay, now question number 2. To the Commissioner, Uganda Revenue Authority, Madam Patience. Do you think, do not think that I'm contradicting myself, or I'm being ironical or paradoxical, but it is for good reason. Do you think we still need these tax incentives in Uganda in the presence and in the availability of industrial parks? I think we are giving all the incentives investors need in the industrial park. Then why are we giving them another 10 years? It's like we are making it easy for them to come and wash their dirty money, then go away without leaving us anything. I beg to move. For God and my country.
Victoria?
Thank you very much. Good afternoon, everybody.
I'll come back.
Now, URA, you are not trying to evade taxes. Why are you so opaque? Why are your activities so opaque? Because you told us that you signed an agreement with this company to do ABC. You signed another agreement with another company to do BCD. We in the private sector would love for you to be transparent. Advertise. If we fail to deliver, then go out there and outsource. But when you leave us here, like once again, we don't have brains, and we are the taxpayers, we don't feel good. That is one. Then 2, on this issue of incentives, if we can continue with the theme of opaqueness, these companies which are given tax exemptions and incentives, is it possible that next year we have a paper telling us exactly which companies they are, the justification, and the impact? Because if we are talking about 3 trillion shillings, that's a lot of money, and I'm sure we are entitled to know what happened. Then, is it possible, I'm now talking to maybe Minister of Finance, I don't know who organized the conference, that next time there will be a taxpayer on that panel, so that they can actually say it as it is? Finally, back to the outsourcing. While it is good to outsource and to consult people who know more than you are, Minister of Finance and URA, please stop outsourcing everything. Meaning, if you want to have a consulting firm, was there no Ugandan firm you could consult? Why is it that until now we have got to go all the way to Georgetown? I have no issues with foreigners. I love them. But then if we are saying building a self-sustaining economy to weather future shocks, during COVID, who was here? It is we who were here. So why are you going all over the world and jumping all over us? I thank you.
Honorable Victoria Sechitoleko is the Vice Chair of the Private Sector Foundation Uganda Board. I thought I needed to state that. Honorable, there's something called benchmarking, but that's not me. I'm not answering
Thank you very much. I have a few things to put across, and I beg to be informed on the following. But before I go further, I would like to have a point of correction on the retired judge that the tax incentive should not be given to people or investors who are coming from outside Uganda only. The word should be, tax incentive should be there to attract investments or investors in the country. Anybody can invest, whether Ugandan or somebody who's not a Ugandan. To my point straight, Madam Patience, out of 98% of business people I've interacted with, when you ask them, why is your business not registered? They tell me, do you want URA to come and close my business? Number one, people don't know why they should pay taxes. Number two, I've interacted with very many people. You ask somebody, why is your business not registered with URSP? Do you want government to close my business and follow me? Also, people don't know reasons and the advantages why they should legalize their businesses. We are always saying, no, 90% of businesses in Uganda don't reach their second birthday. Why? People are not informed. The reason is why they should have their businesses registered and legalized. Next point. When you move outside or in the town, you find that almost 70% of those businesses are not registered, but you find licenses on their shops. Where do they pay this license? Paid against which business name and which TIN number? We are saying government has not collected taxes. How can government collect? How can somebody pay tax? How can government track these people's taxes? People pay taxes, but they don't have the numbers that URA can track. People are paying taxes to individuals, not government. This is a fact. Do research and ask me after you've done your research. Thank you very much. I'm Okongo William, Research Assistant at Parliament.
Okay. Do we have on that side? Yes. No, Kecho, you want? Okay, you're passing on the mic to someone. I can hand over.
Thank you very much, moderator and the panelists. I have an interest in the criteria for the exemption. And the criteria is already laid down there. I just want, I'm proposing to the minister to add one more criteria. I would very much like to see what we benefit from the exemption via exports. In other words, a component of exports should also come in here for our for us to withstand future shocks. Thank you very much.
There is a gentleman with a mic there. Yes, there. No, he has one on the desk. It's okay.
My name is Paul Akuma. I work with EPRC. My question goes to Professor Nadaisa. There's that comparison you've made on Section 4 of a reporting VAT paid on imports at the border, VAT declaration. There's an assumption there that once the VAT assessment has been made at customs, on the same date or the same month, because you have monthly reporting, there's a November there 2015, on the same month someone claims the VAT on inputs, which is quite big, such a big assumption. I think the inputs are compounding of could be a compounding of many years, and there could be lag effects. So the 4 million which accrued there may not necessarily accrue to the value which should have been reported for November 2015. So I don't think the 4 million is entirely as a result of evasion. Some parts of it is part of evasion, but a significant part of it is inputs claimed for other periods. Thank you.
Hi, my name is Alex from the World Bank. I just want to challenge a bit the researchers, so thank you very much for the interesting presentation. But Nada, I just have a question on the custom revenue. You say that Uganda is already collecting 39%. That's much higher than the world median of 5-6%, isn't it, of custom duties and other import tax. If, as the URA director said, if they increase domestic firms' revenue, this percentage is going to go even lower. So I wonder if it's really where we should be focusing in terms of collecting revenues. Of course, it's a good source, but and then also the lags, as our colleague just mentioned before. I was wondering, how did you compare? It seems that you used the transaction level data from customs in Uganda, comparing them with income trade data from the UK or India. And there might be differences there in the HS codes, because maybe the way Uganda reported the import is different than the way that London custom officers have reported the export. So there we might have some inconsistencies in the data as well. So I'm not sure, I haven't read the paper, but I would just think maybe about those issues, and then that might reduce the evasion rate and the discontinuity between reported exports and reported imports in Uganda. Then on going to Liam and other colleagues, just on the tax holiday, I was just wondering, how did you select the beneficiaries and non-beneficiaries, and also the method that you used might have quite a lot of statistical issues, right? And I guess if you did the PSM, if you matched, right, the two groups, there might be also issues there, and I was wondering, how can you already see a difference even before the tax holiday or the section 2.4 was put into place? We saw on the graph that there was a difference, so I was wondering, where does this difference come from? And if you took this into account when looking at the data post effect. That's all. Thank you very much.
Julius?
Okay. Thank you so much for the presentations. I think for me, I'm going to address the front bench here, where my PSST and the cream de la cream of finance is seated. All along, we have been told, and the new PSS is telling us, give me evidence. And I think today the evidence is coming out preliminary, but it is pointing to what we are actually been believing, that incentives are likely not to be benefiting us the way we want. And as such, I'm just having just three recommendations. One is, let us be transparent in these exemptions. And one thing we need to do is, if it is your private money, don't be published. If you want an incentive, let your name be listed in a newspaper or on a website to know company X has the following exemptions, and these were the justifications, to enable an ordinary person, any other taxpayer, to monitor whether these exemptions are being fulfilled. That's one. Two, I've been thinking of trying to think of how we can have an argument on reducing taxes, because right now you can't entertain that argument. But I think IMF has tickled me a bit. We could actually forego these exemptions and instead transfer them to tax reductions. That way, there will be equity in terms of our tax policy system. I think that's something we could begin to think about. Lastly, we need a monitoring framework for these exemptions. There must be whether a team, or I don't know what we're going to call it, PS, but on a regular basis, we must have a monitoring framework on how these exemptions are performing, so that we strike you off if you are not delivering, or we know what we are benefiting out of these exemptions. I thank you.
Thank you. Patience, just two more. We'll have Kasita and the lady over there.
Thank you very much, moderator. My name is Musoke Thaddeus Nagenda, Chairman Kasita. I want to thank our panelists. Mainly our concern as Kasita is why should the government take priority as non-tax incentives as a priority to attract investment? With this, it has a direct impact on reduction of cost of doing business. Secondly, it will improve compliance of tax-paying companies. So we think that with these tax exemptions, they are not viable to Ugandans. We have witnessed companies which come here for 10 years. After enjoying our free land, after enjoying a lot of profits, they rebrand and then they change the name. So that's direct theft. They are stealing, they are cheating us. So we think the Minister of Finance should urgently revisit, given the fact that a lot of research is finding a lot of shortcomings about tax exemptions. Thank you.
All right, just to buy me time, there's a gentleman there as I cross to Hajat. I am managing the time. I'm hopeful you will come tomorrow so we capture all the other questions. They're there, right there. 30 seconds, sir.
Thank you very much. Mine is going to Madam Commissioner from Uganda Revenue Authority. Now, my name is Patrick Edet. I come from Uganda Cancer Society. Now, the issue is you talked about tax education through discussions. I want you to break down categorically. What do you mean by discussions? Because it has come to my attention that you as Uganda Revenue Authority, you always do this tax education once in a while when you come to Kololo here. And two, look at the examples you give to Ugandans why Uganda should pay taxes. For example, when you look at the neonatal hospital in Mulago, I don't think whether my sister, who is from Cadet Primary School down there in Tororo, has ever come to deliver from that hospital, vis-a-vis the costs that are being charged there. Number two, you give an example, Ugandans, we now have our airlines. A poor woman who is paying tax from Karamoja, who does not even know what an airline does to the country in terms of contributing to the tax revenue in this country. Please, you need to trickle down to go to communities and sensitize Ugandans about the importance of paying tax. And look at the examples you give because you scare Ugandans. Recently, you saw what was going on with Uganda Airlines, and you think people are going to pay tax? The saga which is going on the other side? Thank you.
Okay, good afternoon, ladies and gentlemen. I'm Hajat Zaujan Difna, an educationist, and specifically private education service provider. As we come to the end of today, I am feeling really cheated that we have discussed quite a lot and not much attention or consideration has come up about education. But now let me focus on my sector, the private education providers in this country. You are all aware that we are one of the most hit, if not the most hit, sector in during the COVID-19 lockdown. Private schools, private institutions. We went through what we went through. Issues with credit, bank loans, and so on. And the best answer we got from the minister was that if we cannot pay bank loans, then we would rather, or let us go and sell off the schools. That said, we know how much contribution the private education is making to this country. If not to you directly, as someone who went through a private school, at least you have children there, you have people working in these private schools, and you know the much contribution that this sector is contributing to the development of this country, human resource infrastructure, employment opportunities, and so on and so forth. So, as we are recovering from the blow that hit us during this prolonged lockdown, we have resumed the long list of taxes that we are paying. Unfortunately, URA does not want us to talk about the support we are giving to the local governments. Because if you look at the local governments alone, there are a number of taxes that are going through these education institutions. And it is a terrible offense if you do not fulfill this obligation. To mention but a few, we have to pay local service tax for our people, we have to pay rental income, we have to pay postal license, we have to pay trading license, we have to pay vehicle tax. This is only one institution. That is the contribution we make to the local governments, and property rates inclusive. Now, when it comes to the bigger organ, Uganda Revenue Authority, we are conduits, pay as you earn. It's a responsibility, it's an obligation. I've been in the private sector for the last 28 years. And the way I look at our performance, indeed, there's gradual improvement, compliance. People are now getting on board slowly by slowly. And during the times of Nalongo Akol, we were actually in this room. She promised and said, as we widen the base, we shall be able to lower the rates. As we speak today, our income tax is 30%. Now, getting into the recovery process, I want to give a picture very clearly to the members in this room. Getting into the recovery process, the education sector is undergoing so many changes, and we have to get on board. We are undertaking a new lower secondary curriculum. We've started revising the HSC curriculum to align it with, and there are so many demands that are coming up with this new curriculum. Along the way, we've gone through this fragile economy that we have been discussing in the morning. Prices, school fees collection, all these challenges, and the people from whom we are drawing the income, the payment of school fees, are the ones that are suffering, the casitas and everyone, you and me. Then, a few days, I think last week, our minister is called upon in the parliament. Why are schools increasing school fees? So many things bombarding the private education provider without government support. I'm a local investor. I have come on board to help government fight unemployment, to help government alleviate poverty, to help issues of operation, wealth creation, parish development model. We are actually doing the parish development model before even the finances come on board. Because, so really, we feel it is too much for this sector. And now, beginning of this financial year, URA calls, hello, am I speaking to the director of such and such a school? The minister has appointed you. You are going to be a withholding tax agent. Ladies and gentlemen, we are human beings. We are Ugandans. You're talking about incentives. But all these instead are demotivating and demoralizing us people who woke up and said, can we? The mistake is looking at us only as profit-making agents. That's the mistake which our leaders are making. Private schools, these ones are just after making money. But can we broaden our thinking and our understanding of the private sector? I need a comment, withholding tax, and by end of August, we are going to be held responsible. You're non-compliant. You have not submitted. We are going to send people around to come and so on and so forth. So can we enjoy the benefit of being Ugandans, the benefit of having woken up one morning and put up an institution which is educating you people here, your children, your grandchildren, and your relatives? Can we enjoy the paying of taxes in this country by giving us, you know? Anyway, I hope I'm understood, because I have a lot of pain. For over 25 years, I've been paying taxes in this country. As if that's not enough, more is coming on board. But I've never even had a recognition or a certificate of appreciation. The only relationship we have with URA, reminders, submit returns, income tax. If you don't, 2 weeks from now. That's the only relationship that we have with URA. And then when it goes to my boss, our boss there, indeed, expenditure. 126 million that is paying one person in Uganda. I've used that money to pay 4 months' salary in my school. But here it is being taken by one individual. I can use. You take money, we are able to reinvest. Give us chance to reinvest. Give us chance to improve our education institutions, especially after this COVID time. Standard operating procedures. There is no way we are going to take back children to sleeping onto triple beds. We are now thinking that we can adopt SOPs as a culture, as an improvement in our education institutions. But people in this house and everywhere, for them, they think private schools are only there to do what? To make money. Thank you so much. I submit.
Now, Patience, I honestly had some people I was about to give a minute, but she has taken all the time, but she has spoken on behalf of all of us, taxpayers. So I think, Victoria, the taxpayer you wanted at the panel has spoken. She's picked all our pain, PSST. That is really our pain. I won't elaborate. Patience, I think you can also delegate upwards in case, for that particular one, you can also delegate.
That was definitely on my to-do list, that the particular question from Hajati has to be delegated upwards, because I'm not in any position to answer that. But thank you so much, Hajati. Indeed, heartfelt pain in terms of our policy and in terms of administrative issues, but we will make an attempt to give some responses. But also to thank all the participants that have asked questions, very valid questions, valid feedback, and we should be able to give some responses, not very exhaustive, I believe, but we still have another day tomorrow. So please, those of you who have not had the opportunity, please, this is your opportunity to actually come back tomorrow, because we do not want to come back and then the hall is empty. So just keep that question. We will be able to answer it tomorrow. So what we'll do, I think we'll have each of the panelists answering the questions that have been addressed to them specifically, but also making their closing remarks, and then I will be able to come in and give the responses in relation to the issues of the URA. So I will start with Dr. Silva. If there's anything that you'd want to just add briefly, like 2 minutes, we'll go to Professor, and then we'll go to Liam and Dr. And then finally, Isabella, I don't know if you want to make any other comment, and Pamela, and then I will come in and summarize and be able to call upon my boss to come and answer the most difficult question this afternoon. So Dr. Silva, the floor is yours. Just 2 minutes.
Thank you very much, Patience, for thank you very much, Patience, and thank you everybody for raising very interesting questions. It's been a wonderful afternoon. It's good that when we get to share these research findings, we get wonderful comments from you. That is how we improve our results and make them useful to all Ugandans. And I want to tell everybody that let's do our part as citizens in this country. Let's pay our taxes, let's pay them diligently, and then we can demand accountability. But let's do it together. Now, I want to probably say to Victoria, you said, why go to Georgetown? I want to assure Victoria that these are my co-authors. the papers that we presented here, we work on them jointly. We bring ideas together, and then we kind of find a better way of putting results out there. Sometimes I might be constrained. I am from here, by the way. I need to say this. I am from Uganda. I am a Mugisu man, and I work with all these colleagues. So we work jointly to put ideas together to be able to develop this country in a more collective way, but while we gather evidence from all over the world, and that's what our co-authors actually bring to the table. Now, Alex raised very technical questions, which I know that this audience, some of the people in this audience may not appreciate them because we get super technical, but then we restricted both our treatment groups and comparison groups in that study to firms that are in the same sectors. So there are basically about 6 sectors that we looked at. But I also know that the literature on DID has been evolving quite a lot. Each time you look at the literature, something has changed and something has come up. And we're mindful about that. And we did do a DID with matching, but those results were not shown today. Those were like robustness things that we did that we haven't actually been able to actually show today. But we're actually happy to engage with you further on most of the things that you raised, and maybe you have some ideas that you can share with us so that we can actually go ahead and improve on the results that we put out there. The other thing, someone raised something about the question about why not include exports in the analysis we've done. There is a very specific exemption that pertains to exporters. And this exemption came a little bit earlier on, I think in 2007. By that time, we did not have electronic returns. They're basically paper returns. So it becomes difficult on the side of a researcher to actually kind of make an estimate without the data that we need. But whatever we did today was a first step, and we zeroed down on it because this is the exemption that we thought was being used broadly, and it is one where we had usable data that you could actually use. There are other things, other exemptions for agro-processors, but the methodology in estimating some of those things becomes difficult because the timing of the beneficiaries actually varies over time. So we kind of have to think about how do we rightly estimate those. But this is a difficult process, but we started gradually, and we're going to keep expanding depending on how much our data can actually allow. As I conclude, I want to still encourage everybody, let's pay our taxes, let's do our part, because we develop this country together. And if we do not do it collectively, we're not going to be able to develop this country. This country is our own country, and we need to play our role as citizens of this country. Thank you very much.
Great. So I have a couple of comments, a couple of responses, but I wanted to make one comment about a question that wasn't actually directed at me, which is that the tax incentives are a way to attract foreign investors. And I would argue that that's the least effective way of attracting foreign investors, that a better way would be to invest or to address the issues with the economic environment, and that means investing in infrastructure, human capital, that would be a more effective way, if that's the goal. Now, the questions about my project, the lags in claiming credits from the reporting in the customs to the VAT, I agree completely. That's a very important issue. What we wanted to do here was just present kind of to a general audience, so we didn't want to get into the details of what the lags are, but that's something that we need to investigate, and we will do that in future work. We can also aggregate, so look beyond a month, so we can minimize some of these, some of the distortions that would enter because of the monthly data. So Alex, I think if I understood your question correctly about why should we focus on trade taxes, I think that if your point is that trade taxes are inefficient and eventually we would rather not have them at all, I think that's exactly right, that the correlation between trade taxes and per capita GDP is very strong and negative. We see trade taxes being used rarely in developed economies. But given where Uganda is now, given that this is 40% of tax revenue, and that the government needs revenues to invest, to make the kinds of investments that we were just talking about to attract foreign investors. It seems an incredibly important area to look at. And I think actually having more revenues now facilitates reducing trade taxes in the future. On the issue of inconsistencies in code, in HS codes, I think that's something we would need to look more at, but we can also just aggregate HSC codes and just see if we see some of the same patterns. But yeah, I think that's worth looking at. The last thing I wanted to say, to follow up on Silva's comment about outsourcing, I think I failed to make the point at the beginning that I represent a team of researchers, and one of the most critical members of this team is at URA. So this project is, I think, by no means outsourced. So hopefully that addresses that concern. Thank you.
Hi. So there was a comment from Chigo Samuel about the point of incentives. They're supposed to encourage investment. Now, the good news is that our study shows some preliminary evidence that this is what is happening. These incentives are achieving their goal in boosting investment, which is a good thing, of course. Now, what policymakers have to do, they really have to weigh up this balance. Okay, these incentives might boost investment, but at what fiscal cost? As we kept reiterating in our presentation, that there really is a risk that if we keep incentives in place for too long, that can erode the corporate income tax base. So you're absolutely right that these incentives can boost investment. The question is, how long do we keep them in place and in what form? How do we weigh up this balance of protecting future revenues whilst encouraging investment? And this is a really difficult question for policymakers. But our research is hopefully trying to provide some insight that might be able to help answer this very difficult question. And my next comment is to Julius Mukunda. Julius, you mentioned that perhaps our study showed that tax incentives didn't achieve the benefits that the government perhaps hoped for. I want to clarify our findings. As I said to Chigo Samuel, we do find some impact that these incentives have boosted investment. So if the goal is to boost investment, they've potentially done a good job from our findings. The area of uncertainty is whether that results in higher firm revenues and increases the total wage bill of firms. And that's inconclusive. Right now, we don't know. So I just kind of wanted to repeat that message, that our results do provide some preliminary, some tentative evidence that this incentive included in the income tax law, this 10-year tax holiday, does seem to have boosted investment. Thank you.
Okay, I was not really close. There was no question for the IMF. Either I was very clear or I said something completely wrong. So here is my chance to really be clear. So, but I will actually just going to repeat what Ms. Nada said already. We have studies that have shown that what attracts investment long term is not tax exemptions. Yeah. It is stable macro environment, good infrastructure, electricity, internet, roads, highly skilled labor, which means education, simple and stable tax system, rule of law, and good institutions. So in order to invest in all this, you need revenues. Now, Uganda has almost a naturally narrow revenue base. Informality is high, there are hard to tax sectors like agriculture. If you add on top of this tax exemptions, you erode the revenue base further. But there is also another important reason why exemptions can be counterproductive. And this is what I was trying to say. They increase inequity, they increase unfairness, and they undermine compliance. So if people perceive that different jobs are taxed differently, different companies are taxed at a different rate, this is not going to encourage compliance. If people see that the public sector does not provide public goods, they will not be willing to pay taxes. Therefore, what I'm saying, that not necessarily all tax exemptions are bad. This is why we have the benchmarks. But there is a need to review them, and there is a need to do this regularly on a continuous basis. Reviewing them means reprioritizing them, questioning them, the three objectives I was talking about. And most likely, when you do that, there is some space for elimination. So I just invite that we consider that, and I hope that the further steps in this direction would allow everybody to pay less, but everybody to pay something. Okay. Thank you.
I don't think I could say it any better than you, Isabella, and I agree that not all tax incentives or exemptions are good. And I didn't comment earlier about the VAT deeming patience. We had a very detailed debate with various players within the oil and gas sector, and there were all these sentiments about the VAT deeming provisions. When they were introduced back in the day, it was to make sure that there was no VAT cost on investment. As to whether that is still the case now is debatable, and we're having an issue where now there's VAT being locked in the chain, and while some people are benefiting from the incentive, there's a team that is saying you either extend this benefit down the chain or scrap it completely. So, Isabella, I totally agree with you. And maybe the last comment I can make in terms of other recommendations, I believe stakeholder management, especially engaging with the private sector prior to introducing some of these major or significant initiatives, is very key. Things like the digital stamps, the IFRIS, we've seen the challenges that we have had with taxpayers trying to implement these, sometimes because of the very short time frame that is given, the fact that they have to go back, invest in their systems to try and align themselves to the expectations. So it would be nice to make sure that there is sufficient and proactive stakeholder engagement to introduce these initiatives, to engage and see how much time frame they're going to require to recondition themselves in order to be able to comply. That way we are able to all meet the objectives that we are looking to meet from a domestic revenue mobilization perspective. Thank you so much.
Thank you very much, our dear panelists and the discussants. I will now turn to the questions that were for Uganda Revenue Authority. Yes, Honorable Victoria, yes, she does make a point that why are we using the foreign firms? We do this particularly for technologies or solutions where we have tried to look around, but there's not sufficient resource, or we do not see providers, or the providers in that market that are operating in the different countries indeed are also foreigners. This is the kind of benchmark that we do, and once that is ascertained, those are some of the drivers that we consider. But that said, we do have a number of local providers really for a number of IT solutions, for supply of goods and services that we use in Uganda Revenue Authority. So it is not that really that we just focus on the foreign providers. But you do make an excellent point, Honorable, that we need to also give our local people sufficient space to be able to provide some of these services. In even some of these contracts that we have with the foreigners, all these contracts will have a transfer of knowledge and building capacity. That once their period or the contract duration expires, then you should be able to have either a local person taking over, but also more importantly, internal resources being able to take over in terms of supplying and moving forward with this system. So those are some of the parameters or the mitigating factors that we put in these contracts to make sure that there is a sufficient skill base that is grown internally to enable us provide these services, which will then be cheaper. We do have, for instance, in the URA, we have an whole IT department. We have software developers who do work with these providers to make sure that they understand the systems and that they should be able to take over when these contracts expire. But that is a point that Honorable Victoria, that is well taken. To my comrade Patriot, yes, you talked about the incentives, and I believe that the panelists indeed have given a sufficient resource. But from our side, we do believe that, yes, you do need some incentives, particularly for the strategic sectors, the areas where you need to grow. Like if you talk about agro-processing, we all know that we need to increase our investment in that particular area. So then it is, if you look at manufacturing as well, if you look at hospitality or the IT sector as well. So there are those strategic sectors that you feel that government indeed must be able to come in and give these incentives to spur investment in that area. So I think what is missing is the monitoring mechanism, and this is something that Julius talked about, that we need to have a framework. When these incentives are given, who is actually monitoring them? Are they complying with the conditions that are provided for in the tax laws? So to some extent, yes, we do need these incentives. But of course, at the end of the day also, it is the cost-benefit analysis. Are we actually benefiting from these incentives? And if not, and this is, I think, the discussion that we have had this afternoon, that maybe then if there is a recognition that government is not benefiting as much, then we should be able either to scale down the years for the incentives or even the conditions that are applicable. But yes, I agree that to some extent, some of these incentives are needed to spur investment in particular areas. What is missing is the monitoring mechanism. That is my perspective or an answer on that. To Comrade William, yes, I will handle that with what Comrade Patrick has talked about. Tax education is what you're focusing on. I think you've seen our placards on developing Uganda together. Yes, it is true. One of them has Uganda Airlines. Yes, it is our airline, and we need to support it. We have others that have the transport sector and even Mulago. But what you've done, those are just a few that we have. And I think the message or in that campaign is that we want to show the public the taxes that they're paying, what has government done, or how has government used the revenues that have come through. That was just a starting point, but the message I get from here is that we need to go down to the lower person. Because if you show Uganda Airlines, it might not speak to somebody who is in my home village in Yamtanga, probably. So I need to find another way. How can this person that is at the grassroots paying their pay-as-you-earn, how are they benefiting? Things like security, really. Security, yes, we can all agree that really security expenditure to the security sector indeed is a benefit, but that is your tax money. You're talking about the roads, the infrastructure, the roads. UNRWA has been giving us updates on the roads that they have worked on. The road network in this country has significantly improved, but that is all a tax revenue that they're using, and of course a few maybe of other sources of income. So by then I think we need to definitely find a way of making sure people do understand why these taxes are paid. One of the things that we have done as well to be able to go to the grassroots, and then I'll talk about the tax education that you did mention as well. Tax education, I will agree that the way we have handled that strategy in the URA is not the best, and it has not been very effective, because largely we have taken mass sensitization where we call people in a large conference and present a few slides and then we go away, and to us that was tax education. But the bitter pill that we have seen is that that is not effective at all. That you must have your message that is targeted to different groups. You cannot call MTN in a group with somebody that is operating or has a shop in Chukubo, because the message is entirely different. What they're looking at in terms of their pains, they are very different. So you must design a strategy for tax education for the different sectors, for the different segments of the taxpayers, and that is what we are working on. So I believe that next year, PSST, if you call URA here, we should be able to account. I could just be here talking a bit of, giving stories, but you should be able to hold us accountable in the coming year. That has this strategy that you talked about for tax education, has it delivered? But that is one area that we have said that agreed it must be changed for us to be able to make inroads. You make a very important point, Comrade William, that people need fear formalization. When you talk about the URA, it is about receiving a phone call. Yes, you haven't paid this, or you're going to penalize you. But we need to move away from there. And one of the things now we are doing is that, for instance, we are going to have an office in downtown Chukubo, the metro area, so that we are closer to our people, because there's a lot of business in that area. And I'm glad Kasita is here as well. But we need to be close to our taxpayers in those areas. We need to be able to register them. We need to be able to understand what pains do they have for the different taxes, to be able to help them, but also sensitize them. Tax law is one of those evolving areas. There is never, the law is never static. Each year things change, or administrative initiatives come along. So we need to make sure that even as we roll out these different initiatives, that taxpayers do understand what is expected of them. Hajati talked about withholding tax agents. Yes, we have listed them, we have gazetted them, but what is our obligation as a withholding tax agent? So those are the things that I'm talking about that we need to work on, and there is a plan. You will be able to see a significant improvement in that area. But also lastly on that point is that we are working with a number of other government agencies under what we call the TRIP. The TRIP particularly here is that we are working with the local governments, we are working with Uganda Registration Services Bureau, that we have a one-stop center. If somebody is given a license for KCCA, they should be able to register for taxes as well. So it has reduced the turnaround time, but it has brought the government institutions that are in the formalization framework together in making sure that we all look at this taxpayer once. So that sharing of information, that collaboration with the government agencies as well is giving us benefits, and we'll continue to leverage on that to make sure that as government we are speaking the same language. So I will just stop there. So the last question now on the tax, the education sector, I have the honor to ask my PSST to make a few responses on that, and then I will ask Maurice to come and close. So PSST, sir, if you can make a few comments on that have been raised. Thank you, sir.
Okay, thank you. Thank you very much. Before I respond to Hajati, you know, we've been here taking notes. The book was about to get full. So just to be assured that we are really getting this feedback and noting it very seriously. I thank the presenters, the researchers, and those who have discussed the paper, and the entire audience. Now, this paper on evasion, on tax evasion, I came in a bit in the middle. Thank you very much for proving what we have always suspected with that evidence on the under declarations and the fortifications and so on. So URA and my tax policy department, the commissioner is here, and the director of economic affairs is here. So there are no more excuses. The evidence has been presented in court, and we need to really move. There are some institutions that we should just invoice because we've been carrying out some special audits and so on. I don't know why it is taking us this long to act on certain things. When it comes to exemptions, this is where now the the conversation is still ongoing, because there the research has not yet concluded on their findings, although preliminary they again giving us, they are confusing us even more, because we've been having this confusion. I know IMF has been telling us certain things for years, and we are listening to them. The research has supported them to some extent. But, you know, we are a country that is pursuing industrial policy so that we can catch up with some other people who have passed through these stages of development. And in the need or in the pursuit of this industrialization, we of course working on the issues which IMF is mentioning. Those cost of doing business drivers, the cost of electricity and its ability, the logistics, the cost of transport, the cost of capital, the technology, and so on. We are working on these, plus the institutions, the rules of the game. Yesterday, Parliament passed 7 bills in one sitting, geared towards improving as we are reforming ourselves to ensure that we make a government and also the entire country more transparent for the investors and everybody to do business. But as we do those things, we have a host of investors who come to our offices every day in search for these incentives we are talking about. So when you say investors don't need them, and after here I'm telling you I'm going to meet some, I'm not going home. They are coming to say, I want to build that factory there, but I want 10 years of a holiday. And IMF is telling me you're in trouble because you're going to erode. And the research is likely to conclude towards that, the way you've seen it, much as they haven't concluded. So I would want to know whether there are countries which have industrialized without these kind of incentives. I would want that evidence to come into your mix of evidence by bringing other comparative analysis. And also, as you know, no country, let alone Uganda, wants to lose revenue. Because as government, revenue is what gives us that lifeline to provide the services. So definitely no government would not want to listen to one who's saying we need to stop the leakages. So I will agree with Julius Mukunda, my good friend there, that what we need perhaps now is a strong monitoring framework to monitor these incentives, because they are given on a certain promise. We're going to do ABCD. And this is where the return on investment, because if we are now treating them as investment, industrial policy, I'm giving you these incentives to utilize my local raw materials. For example, we have some of the best iron ore in the world. A study has proven that. At first we used to hear a rumor. Recently a study proved. And we want to use this iron ore to produce steel, to stop importing the steel. Those who want to invest in this, they are saying, please give us this incentive. Now, there are certain things they promise. You would want to ensure that you monitor them. So I would want to say that our task is cut out very well. The economic affairs and URA. Next year, we need to come back here in the 7th Growth Forum to report on the status of our monitoring framework on these incentives. Not to come and we sit here, we start speaking the same language that we all understand on the same things. So that one, I promise you, we shall be able to come back here, and there and URA, you've had that very well. Next year. Now, to Hajat, the private schools. You are saying we need to review the taxes paid by these institutions, the rates plus the categories, and all of those other challenges you do have. Of course, Hajati was the first one to send me a note here in the morning before I left, saying that we are the only people you haven't talked about in terms of supporting us. Much as we are private schools, we are not teaching private Ugandans. They are no private citizens. Those are children of Uganda, and she has a very strong point. So Hajat, we shall go back, and we have gotten the message. We shall go back and sit with our policy makers and look into it before we give you feedback on what we can actually do. Please, Kasita, there is this thing which you guys, you keep on talking. Those farms you give incentives, when you give them free land, these tax holidays, after 10 years, they close, change name, and I told the Ugandans, please, say things, tell me things with the evidence. I want that evidence of a farm which has benefited from our incentives and now it is metamorphosing into something else. I will act on that farm. If you don't have evidence, please stop saying these statements, which are general. I would want evidence. There is a farm here, don't worry. If you fear to be victimized by these farms, you come quietly and you tell me, all right, and anonymous. But you know, those also whistleblowers have problems. Sometimes they whistleblow on things which are not there. You come silently. I'm a very good person on protecting identities of people, and we manage those aspects. Otherwise, I thank you very much. Unless if my deputy DST is here, if he has something, please add on before we close it. Perhaps I think the Director of Economic Affairs.
Thank you, PSST. I think you have said it all, because I don't want to repeat, or else I may say something different, which is very wrong. So I think I go by what you have said and what panelists have said, and to thank the panelists for the job well done. Thank you.
Thank you very much, PSST, for those remarks and for reassuring Hajati. I can actually see from where I'm standing that she has a smile on her face. Yes, so thank you so much, PSST, for those remarks. And Hajat as well from the URA. We do recognize taxpayers on an annual basis, but also it is a feedback that I've taken that we need to see how we can increase that base of the taxpayers that we do recognize and appreciate. So thank you so much, PSST, for those remarks. So participants, thank you so much for all the input, the questions, for your patience as well in sitting here and listening. And let's give one hand clap to the panelists and the discussants for a job well done, for educating us. And the research, yes, indeed, the discussion continues. So allow me now to hand over to Maurice to be able to give a few remarks and then officially close this session. Maurice, you're welcome.
Please take your seats. Feel free to take your seats. Ladies and gentlemen, another round of applause for our panel and our chair. I want to appreciate Patience because she turned from being a chair to a panelist at some point, and you helped buffer some of the pressure. But I think that also informed us that the next time, Albert, URA must be a panelist, not the chair, on domestic resource mobilization. I really want to thank the team for a job well done. Yes, Honorable Victoria, I remember I was speaking to the issues on outsourcing consultancy. I remembered in January, one of the speakers from Georgetown University was our very own, Marcela, was it Habyarimana? I'm trying to forget the name. Yes, Maurice Habyarimana, I think, or something. James Habyarimana. And he's a lecturer at Georgetown University and did an awesome job in January when we were here for the Growth Forum. I think working together is an excellent thing, and I don't think this was outsourcing. So PSST, I will protect you on that one, and Albert for for doing this. Ladies and gentlemen, we really have come to a close. I would run you through some of the key outputs, but I think the PSST did a fantastic job, and for us, the biggest takeout today and tonight, especially with this particular session, was that monitoring framework. And I really want to thank Julius for raising this. The monitoring framework on the tax exemptions and incentives. Patience, we will be here and we will hold you and the team accountable on that output. So please note. But I really want us to appreciate that this conversation generally has looked at what has been a global concern around the issues of the shocks that are affecting us, relatedly due to climate change and of course the war in Europe. And I really want to thank Dr. Newfarmer, who raised the issue of the optimism we have that we are turning the corner. And looking at the PSST's presentation, it looks very nice and good and looks like we are turning the corner, but we should prepare ourselves for what might come and hit us, that train that might be coming. And we see it already with what's happening in Europe. I really want to appreciate the conversation on the green growth strategy and climate financing and some of the opportunities that have been shared with us. We understand the consequences of climate change that are upon us, and Uganda in this region has clearly faced some of the wrath of climate change. And we may have survived the drought in the last few months because we had quite a sizable basket of food from the previous long rainy season, but that doesn't mean we won't have a worse drought in the next year or within this financial year, and we need to protect ourselves. And I agree, protecting Uganda's natural capital is an area of concern that we must address. And yes, Patience, we must support you on digitizing and enhancement in that space to harness the domestic resource mobilization. And we will support you, as I'm speaking now as the fourth estate, the media. We will support you in all the campaigns to ensure that you deliver on that mandate. So ladies and gentlemen, this conversation really continues. I don't want to dig into the conversation on the tax incentives. That's an open conversation. And Director Moses Kagwa will probably have other platforms, including UBC, to speak on this and many more issues. That said, I want to remind you, we have day 2 of this forum tomorrow. Registration starts at 8 a.m. and we will have our first session at 8:30 a.m., session 3 on exports to promote growth. And I will be here. This time the bell will be in the room, not in the restaurant. And we'll try and ensure that all the content is captured within the half-day sessions so that we have lunch and then return to our other businesses. So I really encourage you to tell our invited guests and friends and colleagues who should have been here to join us tomorrow. But if they can't make it, then we will have the social media platforms and the online platforms that will be broadcasting both sessions. But I really would like to encourage you, because we will have our Prime Minister, the Right Honourable Prime Minister, who will be closing this forum tomorrow in the afternoon before we close for lunch. So ladies and gentlemen, I really want to request that we put our hands together for a very successful day 1. Thank you
all for being part of this conversation. On behalf of the Ministry of Finance and on behalf of IGC, I want to thank you for being part of a very successful day one. We have several stakeholders and partners who are in this room, including our development partners. We want to thank them, members of the press who are broadcasting this live in the morning and who have been sharing this on social media and who will be sharing the information we have received today on the different platforms effective tonight and tomorrow. We want to thank you, and I want to welcome you guests to Ugandan coffee and Ugandan tea that has been served at the back of this room. Thank you very much. See you tomorrow morning.